Good day, and welcome to the ServisFirst Bancshares Incorporated fourth quarter earnings conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. Please know that this event is being recorded. I would now like to turn the conference over to Mr. Davis Mange, Investor Relations. Please go ahead, sir.
Thanks, Chuck. Good afternoon, and welcome to our fourth quarter earnings call. We will have our CEO, Tom Broughton, and our CFO, Bud Foshee, covering some highlights from the quarter, and then we'll take your questions. I'll now cover our forward-looking statements disclosure. Some of the discussion in today's earnings call may include forward-looking statements. Actual results may differ from any projections shared today due to factors described in our most recent 10-K and 10-Q filings. Forward-looking statements speak only as of the date they are made, and ServisFirst assumes no duty to update them. With that, I'll turn the call over to Tom.
Thank you, Davis, and good afternoon to everybody on the call. First thing I'll do is kind of recap 2019 and then talk about 2020 a little bit moving forward. So, to restate to you, most of you have heard it, what we say we are. We say we're a disciplined growth company that sets high standards for performance. And I think 2019 did not meet our high standards for performance that we would like. To give you a recap of the year, the year was negatively influenced by a confluence of three main events. One, obviously, is we encountered unexpected margin pressure in 2019. The result of that was obviously everybody realizes where we are with that. Maybe we were a little bit slow to react to it, possibly, but in any event, that was obviously one of the factors. The second is we hired 24 great new producers in 2019. Those great producers are going to pay off in 2020, but certainly they were dragged to income in 2019. And the third thing is that we've had added substantial new hires at the suggestion of our regulators over the last 2 years, as we have already transitioned to a large bank regulatory team from the state of Alabama and FDIC. So, all in all, sort of the year was like a golfer would call a son-in-law shot. Not what you wanted, but we'll take it. So, with that, we'll talk a little bit about where things really got better in the fourth quarter. It was margin improvement, and Bud will go over it by month in a minute, but, it's much improved over where it was in the third quarter. And our management team spent a lot of time on margin management in the fourth quarter, and we're certainly pleased with the results. The loan growth for the quarter was 14% annualized and 11% year over year. And the deposit growth was very solid at 9% year over year. To give you a little bit of overview on 2020, we see those 24 new producers is starting to really pay off in 2020. We added new banker teams in Charleston, 3 bankers there, Nashville, 5 bankers, and West Florida we added 7 new bankers, with the rest scattered among our other regions. To give you an example, typically our pipeline is at a seasonal low at year-end. Our pipeline today is 50% higher than 1 year ago, and a lot of the impetus for that is these new bankers and the efforts they put forth on average, most of them have been here 6 months or less, that are starting to contribute. So we're seeing, loan growth and seeing good loan pipeline in the first part of 2020. In addition, I would also say that the heightened payoffs that we've seen on a quarterly basis, the last 3 months of 2019, both C&I and as most of you know, we're not as big a CRE bank as most banks, but we've had some CRE payoffs there. So we think that'll abate, and it feels like in the first half of 2020 there'll be substantially lower payoffs than the last 3 quarters of 2019. So certainly that'll help us, going forward. when you say we had loan growth of 11% year over year, certainly that loan growth in a normal year with normal payoffs would have been well in excess of 15% if we'd had the normal level of payoffs. So just to give you an example. We also placed an increased emphasis on enhancing fee income. Going forward, we realize that we are lower than most banks in fee income category, but we're doing everything we can from service charges to many other things to enhance fee income. We're also trying to enhance loan income in terms of origination fees, unused fees, and other matters like that. So we're working on enhancing income where possible and combining that with expense management. We mentioned last quarter that's an increased focus for us. Going forward, we're looking at every expense category we possibly can. We think obviously we'll have some expense increases in 2020 from all the hires we made in 2019. There's obviously a carryover effect, but we expect to see improvement in almost every quarter this year, and also we'll see improvement in expense growth in 2021. We've always tried to be highly efficient and try to be good stewards of our shareholders' money. We've asked all of our partners, vendor partners, to work with us to manage our costs down, and we've certainly been pleased with the response. Bud and his team have spent a lot of time working with our vendors. We've also found that we've increased in size. We do have better purchasing power in some areas, so certainly that's been enhancing income and controlling expenses has been a big focus for us. So just to give you a little overview there of where we think 2020 will be. And now I'm going to turn it over to Bud for more details on the financial results.
Thanks, Tom. Good afternoon. Our net interest margin increased from 3.36 in the third quarter to 3.47 in the fourth quarter. By month, the margin was 3.41 in October, 3.47 in November, and 3.52 in December. The decrease in our deposit balances for the fourth quarter was partly due to our decision to be more proactive in reducing deposit rates across the board. Our average excess funds decreased by $162 million in the fourth quarter. The cost of our interest-bearing DDAs for the fourth quarter was 1.21 compared to 1.59 for the third quarter. And by month, it was 1.32 in October, 1.17 in November, and 1.14 in December. Our loan yield was 5.17 for the third quarter and 5% for the fourth quarter. Again, by month, October was 5.04, November 4.97, and December 4.98. Our loan growth, 2/3 of our loan growth did take place in December, so the margin will feel that impact more in the first quarter than it did in the fourth quarter of 2019. For 2020, for our net interest margin, we're forecasting a range of 3.50 to 3.55. And just a reminder, we have no accretion income related to acquisitions. Non-interest income, we're up $842,000 quarter over quarter. That was primarily driven by an increase in the cash surrender value of a BOLI purchase of $75 million in early October. Year over year, our credit card income increased $1.5 million or 27%. We added 26 new companies to our credit card program in 2019, including 23 through our American Bankers Association credit card referral program. Mortgage banking income grew $1.6 million year over year, or 57%. Reminder, we do not sell any government guaranteed loans to generate non-interest income. Non-interest expense is up $458,000 quarter over quarter. Our FDIC assessment returned to the normal run rate during the fourth quarter. In our budget, we are assuming that run rate will stay the same for 2020, and if that's the case, our 2020 expense will increase by about $2.5 million. In the fourth quarter, we made a $1 million adjustment to our incentive accrual. We decreased that accrual during December, and in fourth quarter of 2018, we had a reversal of $816,000. Loan loss provision, fourth quarter net charge-offs were $6.5 million. 83% were previously impaired. We continue to be proactive with our problem credits. $5 million of our charge-offs were related to 4 credit relationships. 3 of the 4 are in bankruptcy, and we have no remaining exposure to the fourth borrower. As we discussed in the third quarter, the bank participated in the state of Alabama operated loan guarantee program. It was terminated in the third quarter. We were notified of this in July 31st. We had 86 loans enrolled in the program, and we had about $53 million in total loan dollars. We lost $22 million in guarantees in favor of a one-time payment of $7.4 million. $1.3 million of that $7.4 million reserve was used in the fourth quarter for one credit. We've analyzed the remaining portfolio and determined that a reserve of $3 million is adequate as of 12/31/19. For 2020, we're budgeting net charge-offs of 25 basis points of year-to-date average loans. Our Chief Credit Officer, Henry Abbott's on the call and can address any credit-related questions. One comment on CECL. We have to make a day one adjustment this month to retained earnings, and that adjustment will be a positive $1.5 million. Taxes for 2019, our year-to-date rate was 20.1. It's 20.9 without stock option credits of $1.5 million. In 2018, that rate was 18.9 or 21.2 without option credits of $3.9 million. For the fourth quarter, the rate was 20% or 20.6 without option credits of $297,000. Fourth quarter 2018, the rate was 18.9 or 22.2% without option credits of $1.5 million. For 2020, we're projecting the rate to be 22%. We lose some new market tax credits in 2020, so that's the reason for the increase in the tax rate. That concludes my comments, and I'll turn the program back over to Tom.
Thank you, Bud. And in a minute we'll take questions, but I'll just finish by saying we feel good about the start to the year. Our loan pipeline is good. We see good activity out there. We're seeing good activity in terms of increasing our core relationships, deposit relationships as well as loan relationships. So obviously building those relationships is the key to building a successful bank, and those core relationships are doing very well, and we feel like we've got momentum in all of our markets and are doing quite well there. So with that, we'll open it up to questions if there are any.
We will now begin the question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. At this time, we'll pause momentarily to assemble our roster. And our first question will come from Brad Millsaps of Piper Sandler. Please go ahead.
Hey guys, how are you doing?
Hey, Brad.
Hey, Brian. How you doing?
I'm doing great, but I appreciate all the guidance. I was writing quickly. I know you guys have talked a lot about managing the expense line in 2020. I think, but some of your comments were maybe specifically addressing the FDIC line item in terms of that increasing $2.5 million. But just kind of curious, bigger picture, on expenses. Last couple of years it's been kind of in that 9, 10, 11% range. It sounds like based on your comments, you're going to be able to back off that a little bit, and just curious any more color there on kind of where you think those can fall out.
Yeah, really go back to salaries. I think is the biggest thing. We'll probably have an increase around 6% in salaries. We added some teams in 2019, but for 2020, we'll only add revenue-producing personnel. So we didn't add that many in the budget. So really, we see that as being the biggest line item that we're able to control, just not adding staff in 2020.
Okay, and then maybe just one follow-up, Tom, on loan growth. Sounds like you're pretty confident around the loan pipeline. You've been up double digits the last couple of years. Just curious, what gives you confidence that pay downs won't be as high in 2020? Does that mean you can kind of do better than that, 11, 12-ish kind of % growth?
Yeah, we project loan payoffs just like we project the pipeline. So the payoff pipeline is down. I think there's a few in the first quarter, but then after that, it seems to be that we're seeing a tailing off of pay downs. Brad, so that's based on that, and plus just you get a general feeling from you don't hear as much about getting a payoff on this or a payoff on that. That a lot of stuff's paid off, obviously. So after a lot of stuff's paid off, there's not as much stuff to be paid off. So that's why if that answers your question, Brad.
Yeah, sure. No, that's helpful. I appreciate the additional color.
Yes, sir.
Our next question will come from William Wallace of Raymond James. Please go ahead.
Thanks. Just, Tom, as a quick follow-up to the last question. So you said in your prepared remarks, and I apologize I missed it, you said if payoffs had been normal or hadn't been accelerated, your loan growth would have been what in 19?
Over 15%.
Okay. And are you anticipating that your loan production in 2020 will be similar to 2019, or do you expect an acceleration given all of the new producers that you hired in 19?
That's a good question. It's hard to project out more than about 90 days on the pipeline, Wally, but we're generally optimistic about, the future of the year. So, but we think it'll be, certainly the net loan growth, we think it'll be stronger than 2019. Just, probably the same level of production and just less in the way of payoffs, if that makes any sense, Wally.
Okay. So based on what you're seeing in the pipeline, and I think you said you get lots of anecdotal evidence that's giving you confidence that payoffs should normalize, does that mean that a 15% growth rate in 2020 is kind of in line with your expectations, or is that you would still expect some level of payoffs above normal?
We would have some payoffs, so having a net run rate of 15 would be on the aggressive side, Wally, we think.
Yeah. Okay. And Bud, you mentioned you gave some good color, and I wasn't able to write it all down about trends on the costs and yields. But if you kind of put it together to net interest margin, what are your expectations for 2020, given what you're seeing, and assuming we don't see any more movement from the Fed?
Yeah, we think our range would be 3.5 to 3.55 for 2020.
Okay, and I apologize if you gave that in the prepared commentary. Just one little ticky-tack question on tax rate. You said anticipating about 22%. I assume that's your statutory rate, and you would expect to continue to see some level of benefit from options and restricted stock.
Yeah, even though the option pool is running down. I mean, I'm not sure how much we have left, but I mean, we'll probably have some activity. We just don't include that in our forecast.
Yeah, there'll be some, Wiley, probably the reduced run rate from what we've had in, a bit reduced from 2019. And I don't think, by the way, on the FDIC premiums, I don't think any of us know what they're going to do. Now, why they don't just set a reduced rate at which they're collecting, they're acting like, well, we may have a lot of problem bank failures all of a sudden, and so we're just going to continue to charge at the normal rate, and then we'll refund you the money at some point. So, I don't think it doesn't make sense the way they do it, but it is an area of the government. So we'll wait and see what happens there.
You just have to do what they tell you.
Correct.
I'll step out and let somebody else ask a question. Thank you, Tom.
Thank you, Wiley.
Again, if you have a question, please press star, then 1. Our next question will come from Kevin Swanson of Hovde Group. Please go ahead.
Hi, guys.
Hey, Kevin.
Have you guys started to see any impact from possible merger dislocation, with some of the competitors linking up and some of the MOEs? And maybe is the plan similar to the past in terms of kind of how you attack that opportunity?
Yeah, without getting into specifics of who we're talking to and where, Kevin, we see them, they're starting to be, it's never as early in the process as people think it's going to be. It's always later in the process of where that happens. So, and also you've still got some situations where there are banks that are having some issues. I don't need to tell you who they are, bigger banks. So you see a little bit of movement there from some people that are looking around that have never looked around much in the past. So, in any event, we see, good activity out there right now. We're talking to people all the time, Kevin, and we see good activity. We see good possibilities, and a lot of them are within our existing footprint, which is even better, certainly, since we've already got an office in these markets, the 10 markets we're in, or 10 or so markets we're in. It's much easier to hire people. So, yeah, we're starting to see anywhere there's a merger, that's going to create a little bit of activity for us.
Thanks. And then I guess if we're kind of talking on this call a year from now, if results come in better than expected on some of the growth that others have touched on, is that kind of the only data point you think we would kind of look at throughout the year where revenue growth could be even stronger, or do you think you could? There's still some liquidity on the balance sheet. Do you think that the NIM could outperform? I guess what would be kind of the targets that would lead to kind of better performance, I guess, in your mind?
Well, certainly, revenue growth, number one, but expense control, number two. We're going to, again, I think you'll see improvement, not necessarily in the salaries the first couple of quarters, but every quarter you're going to see improvement in the expense line items, Kevin, as the year goes on. So we're getting control of that and doing a little bit better job of, controlling the shareholders' money. So we feel good about those two things. Certainly we've reduced excess liquidity in our quest to improve the margin, but we want to keep our margin in that range where we are today, the 350 to 355 range. We'd certainly like it to be better, but, for the time being, we'll take it.
Thanks. And then maybe just one kind of follow, it looked like overall, on a credit perspective, some of the metrics improved. Was there anything new in any of the buckets or anything that left? Maybe just kind of share any additional color on just kind of credit in general. Thanks.
This is Henry, and no, I think in the fourth quarter there was not anything new. We actually did have some pay downs on some problem credits, so no new major watch list items, and rather we exited some credits.
Okay, yeah. Thanks for the time.
We see most of our, credit quality trends all pretty much improved in the fourth quarter, but it's time to do it. I mean, we should see some improvement, so we're optimistic on that front as well.
Thanks, guys.
Thank you.
The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.